Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello everybody, this is Coach D with TackleTrading.com, here to come at you with the play of the day. Now, with the current market conditions, how can we best approach the market with the type of, I'd say, uncertainty we have around market direction? And what I mean is, if we stop and take a moment to look at the chart of the S&P index, the market is literally kind of in this smack dab between support and resistance, between bullish and bearish, between, general confidence in the economy and particularly this week in the Fed, and lack of confidence thereof. And the market, with today's price action being a doji in here, get a good quick look at that inside doji we talked about in the update. This could really go either way. And if we take a look at our economic calendar here, let's go to the Trade Center and look at our economic calendar. We've got that FOMC policy statement coming out. The meeting starts today, but the actual announcement's going to be tomorrow. And that's a big deal. Whenever the Fed talks, we've been talking about this time and time again, that monetary policy is one of the biggest market movers, or catalysts, if you will. So looking at that, we've got market kind of in a primary uptrend, near-term down drop with a retracement back up. So you could look at this from like a bearish retracement type perspective, or you could look at it from a bottoming perspective. But today's price action being a doji is really exactly what I would expect heading into the Fed meeting, which is this little game we call wait and see. You'll notice today's volume was relatively typical. Tomorrow, early in the day, we'll see pretty quiet movement. I don't think we're going to see anything significant until after the Feds talk. Then once they talk and that sentiment becomes clear, sometimes there's an initial knee-jerk reaction, but we'll see the subsequent reaction to that information. And the market's going to probably pick a pretty good direction from which I expect the market to then move the remainder of the week. So we could probably see it, if the Feds come out and they're very dovish and the language sounds very confident and that they're going to continue to toe the line. They're going to say foreseeable future and that they're going to be patient and they're going to keep the policy, conducive to low rates. That might stir the market to confidence. We might see it rise from there. If it comes out sounding a little bit hawkish and the language is not as clear and there's some uncertainty and lack of confidence, the interpretation thereof, we might see it head to the downside. Whichever way it goes, we can certainly take action with our bullish and our bearish type trades. But I also wanted to talk to you a little bit about where we are in the time of the year where we're kind of in that lull between earnings. So we've gone, we're through Q1, we got Q2, we got the earnings announcements that we are kind of waiting for, that little lull right now. And a volatility strategy is an excellent pick from the playbook right now based off of which way the market's going to go. So I'm going to come at you with two separate videos, and I'm going to do it on the same stock. I'm going to do them on ISRG. And the reason I'm going to pick ISRG is because it has a very good volatility personality. Now, the stock in and of itself, you see has some erratic movement around earnings. You can see the earnings announcement, boom, big gap, earnings announcement, crazy gaps, big movements on earning, and then not so big movements on earning. But the general idea is that this stock has the potential to and has the history of moving at earnings. And that's not necessarily a good personality for the people who own the stock, but it is a very good personality for the volatility cycle. Volatility cycle. So here I've got this chart with three indicators applied to it. I've got historic volatility in pink, implied volatility in blue, and a probability of expiring cone up here, which gives me kind of a statistical ballpark where the market, based off of the current implied volatility, thinks that the price action is going to stay within that range. But then we have the catalyst of the Fed, which could help movement. And then I know that earnings is coming in about 6 weeks. So in about 6 weeks, based off of the historical pattern, the implied volatility on average should rise. Works like clockwork. Here's earnings announcement about 6 weeks prior. We see the implied volatility start to rise. Earnings announcement, about 4 to 6 weeks prior, we see that implied volatility start to rise. Here again, 4 weeks prior. So that 4 to 6 weeks prior to is that sweet spot. Which, by the way, if you're going to own a stock and try to insure it through earnings by buying protective puts and whatnot, this would be the time to do that while the implied volatility is low. Now, I have 2 core strategies from my playbook to take advantage of this same phenomenon, the volatility cycle, and these are called Vega trading cycles. So with Vega trading cycles, the general idea is I'm not necessarily going to try to make money on the direction. I'm not necessarily going to try to make money on the time decay. I am going to try to make money on the implied volatility cycle, the increase, the Vega rise. So we're going to kind of catch that Vega rise. And then there are Vega negative strategies which try to take advantage of the crush. So Vega trading is not the hardest type of trading to pull off. You just need to make sure you clearly understand it. Now, the 2 core strategies I want to use to catch this volatility rise, the Vega rise, that have been my favorite go-tos are one, which is a bi-directional strategy, which is a straddle, where I come in and I buy a call and a put, or I can do a strangle where I buy calls and puts at different strikes, and try to create a very strong positive Vega posture. And then I will come at you and show you how to, well, with that particular strategy, that's based off of the idea that it's going to move up or down. I don't know which way, but that it moves is important. So it's a trade where I want it to move, and I think the implied volatility is going to climb, and it's going to happen fast enough that it'll offset the time decay. So the straddle or the strangle is theta negative, but Vega positive. Then I'm going to turn around and I'll do the same trade for you in a different video with the double diagonal, which is based off of the idea of I don't really want the stock to move more than a standard deviation. I want it to stay in the middle, which is likely as well because it's going to have a high probability of reverting to the mean. If it runs up, it'll probably come back down. If it runs down, it'll probably come back up. In the next 4 to 6 weeks, we'll see probably an up cycle and a down cycle. And in that time, I know that time's going to decay, so if I can get positive theta, that would be a beautiful thing. And I still think that volatility is going to rise. So a double diagonal is a good way for us to create a theta positive, Vega positive strategy. So that's what we'll be coming at you with, and I want to make sure that you understand that Vega trading strategies can be a very important part of your playbook.